Hello, good morning, everyone. Welcome to all of you for AFM session. Students, just let me know whether you people can hear me well. You can respond me in the chat box, or you can open your mic and talk to me as well. Yes, please. Can you hear me?
Yes.
Yes, morning. Yes.
Morning. Good. So, students, uh, since it is the first day of the class and number of students, they are joining for the first time the online class with us. So they are in the just queue. Okay. So, or let us wait 2 to 3 minutes only. Okay. So 2 to 3 minutes we will wait, and then we can start our lecture for AFM. So just please 2 to 3 minutes. Thank you for your patience. So students, let us start discussing. Students, first of all, some introduction. My name is Hamzah Siddiq, and I have been teaching ACCA since last around 13 years. Yes, around 13 years I have been teaching, and I teach audit and financial management, my two specialities. F8, P7, F9, P4. So these are my specialities, 4 subjects I teach. So students, now I want to know about you people as well a bit. So I would request, in the alphabetical order, I want to know about you people. So start with the Deepa. Yes, please. You will state your name, and you are studying first time online class or before you have studied, and whether you are doing AFM first time or not. So 3 things you will tell: name, your experience of online class, and first time or not, and AFM. And so third, fourth is the you are working or not. Yes, please, Deepa. Yes, please. Open your mic and introduce yourself, please.
Hello.
Hello. Yes.
So hi. I didn't hear you for quite some time. I was adjusting my earphone. So I'm Deepa. I'm from Mauritius,
Yeah. Good.
and I'm studying part-time for the time being.
Okay. So you're working as
Yes,
well?
I'm working. Yes, working.
Okay. Okay, right. So yes, Dia, please. Thank you, Deepa. Thank you.
No
Yes, Dia.
worries.
Yes, please.
Hello, I'm Dia. I'm from Mauritius as well. I work in the banking sector, and it's my first time doing AFM, and I
Okay. All right.
had already done P7 before.
Thank you. Thank you. Yes, Khatija, please.
I'm Khatija, first time doing AFM. I'm a full-time student at the university and also at ACCA.
Okay. Thank you, Khatija. Thank you. Yes, MJ Romina, I think. Yes.
Hello, sir. I am Romina from Mauritius also. And it's the first time I'm doing AFM, and I have already done SBA online with another teacher.
Okay, right.
I'm working in an offshore, in finance offshore.
Right. Thank you, Romina. Thank you. Yes, Manisha. Yes, please.
Hello, I'm from Mauritius. This is my first time doing IFM, and I'm currently working full-time in a management company.
That's good. That's nice. Thank you. Yes, Priyanka.
In a management company.
Right. Okay. Now, Sandeep. Yes, please.
Good morning, everyone. So I am Sandeep. I work in the banking sector. I'm doing first time online classes, and
right. So you're doing only AFM this time?
I'm doing AFM and audit also with you.
Okay, right. Because I was just recalling, yes, you were present in the audit class as well. Right. Yeah. So yes, Zakia, please.
Hi.
Hello.
I'm Zakia. It's my first time doing AFM.
Right.
I did ATX with Mr. Ali Shafi online.
Right.
I'm working in the public sector.
This name seems familiar with me. I think,
Yeah, I know you from BSP.
yeah, yeah.
Yeah,
I was just recalling that I know. I
yeah.
think you have studied with me over there,
Yes, I
right?
did audit with you there.
Yeah. Okay, good.
Yeah,
Right.
okay.
Okay. Thank you, Zakia.
Yeah,
Okay,
okay.
students. So let us proceed with the subject. Advanced financial management, just like all other professional optional paper. Optional paper it is. So it is a bit challenging, I must say. Challenging in the sense, AFM, just like ATX or APM, so which means it has syllabus, big syllabus, and you know that. So what will be their knowledge of AFM subject that will be needed? We need. And then there will be technical knowledge, and it is technical knowledge, calculations, details, topics, and I'll be talking about the same. So then there will be, of course, based on knowledge, you have to solve scenario, you have to calculate NPVs, MIRR, you have to calculate hedging, outcomes, calculations. So, which include, I must say, knowledge includes calculation of certain aspects in the syllabus, and you must have a good command on that. And that can be, of course, achieved through practice, practice, and practice. And the second is, after with the calculation, then you will be having uh, theoretical part of the subject. Now, this theory, in my opinion, I'm telling you on the very first day, that in my opinion, in AFM, students actually struggle because of the reason they don't know how to tackle this subject, how it is different from others. They try to go for perfection. I'm saying perfection. What is perfection? Perfection is that I am doing a calculation that should be 100% correct. You must be thinking, what Mr. Hamzah is saying on the first day. Yes, I mean it, what I'm saying. So you need not to be perfect in calculation when solving the question in exam. When you are practicing, of course, we have to try to be perfect in that. The point is, AFM is an analytical subject. I'm saying use a required skill of analysis, professional approach of finance, senior manager. It means your major role will be in the terms of advisory, advise finance, advise on reconstruction, advise on merger and acquisition, advise on hedging choices. Now, when you advise, so it is not 2 plus 2 is equal to 4. So that's a calculation has a role up to a certain extent. So it means you must be able to discuss the other relevant factors from the scenario itself, from the theoretical knowledge of subject, and apply that to scenario along with calculations done, which you will be doing. So in my opinion, your subject, if you pick the past papers, around 50% marks on average, sometimes 55% marks, they are based on this analysis. What students do? They spend the whole time on calculation. I know calculation takes a lot of time. But we have to rise above calculation. After doing calculation, above that, the next step. So calculations of profits, loss, NPVs, WACC, and other items, different ratios, we have to rise above that. And we need to be able to analyze and advise along with the technical knowledge of AFM, specific, you see here, what I'm saying, advise as per the technical knowledge of subject. We have to apply that scenario specific information which is given in the scenario of a company's aspect. Then we have to utilize the calculation done. Sorry. So these are all the points. These are all the factors. So you see here, this is the ultimate, we must be able, this is the capabilities we need to achieve. Capabilities to be achieved. Now, next, for that purpose, of course, the sequence is the same. Technical knowledge we will achieve. We will be doing practice questions. Now, because now your exam paper of AFM has 80 technical marks, 80 marks technical knowledge, and 20 marks professional. This segregation, your examiner, 20 marks. What I was saying here, scenario specific, justify, utilize. So basically, these professional marks are all around that. 3 questions are there. Question 1, 50 marks, and the remaining 20, 25 marks. So, okay, you don't have this. Yes, let me share it with you, people, here in the chat box. It will be uploaded on the even website as well. So it was easy to access course detail on the website, or it was complex process? Tell me, give me feedback. It was okay. Rate complexity 1, ease 10. How easy it was? Tell me to reach the class. Tell me. Give rating in the chat box. 10 is for the ease. I'm sending you meanwhile. Good. Course plan. Good. Thank you. Thank you. Thank you. So I have sent it to you via course plan. Please, in the chat box, you can download it. Okay, you can download it from the chat box. Course plan is there. Now, so advanced financial management, we are starting today. So students, things are in front of you. That basically, let us talk about syllabus first. What is the syllabus? Syllabus. The syllabus basically, there are 3 major portions of the syllabus. One is called investment appraisal. Investment appraisal, which includes the whole investment appraisal techniques, which includes investment appraisal techniques, appraisal techniques, multiple techniques, those techniques which you have not studied before, even they are there. Second is VAC is part of it. Then real option is there, yes. Then is risk and uncertainty is there. Capital rationing is there. If I say this portion is around 40% of your syllabus, it will not be wrong. Minimum 40%. Next is, the second is mergers and acquisitions. Second section. Merger and acquisition utilize the knowledge, some knowledge from investment appraisal. Utilize knowledge from, yes. And I will add with it merger and acquisition, corporate reconstruction as well, because they both are interlinked. This is the way I classify the syllabus into different parts. So merger and acquisition, corporate reconstruction. Again, it is, if I say, around 30% of the syllabus. Yes. And the remaining 30% is the risk management techniques, which includes currency risk management, interest rate risk management. Yeah. Around 30% of the, now, yes, there are some addition I will add. In general, there are some theoretical topics additional. Now, you pick any exam, any past paper. Now, students ask me, Mr. Hamzah, tell me which topics are most likely to be tested. So my answer is very simple about AFM. Now, there are 3 sections of syllabus. Every section has to be tested for a minimum 25 marks. Minimum 25 marks. You cannot ignore a single section. Minimum 25, I'm saying. Up to 40 marks. Yes, in exam. Now, next. Come here. So this is the our course plan. It is 20 lectures plan, but I'm telling you in advance. Normally, every session, I spend around 22 lectures. I'm telling you in advance. Means 1 to 2 additional lectures. This is what I'm telling you on the basis of history. Because sometimes some topics take more time for comprehend. Students take more time to comprehend. Means I have to repeat again and again, explain, or for additional questions, I have to do. Now, come here. So we will be starting with the Advanced Investment Appraisal. Then risk management. You see here, it is taking 8 lectures minimum. It may take 9 lectures. I'm telling you in advance. Then risk management, it will take around 6 lectures, 6 to 7. And these green, which are highlighted, these are additional classes. These are all on Sundays. And my plan is to conduct these classes Saturday evening. Saturday evening. Will that be good for you people? Saturday? This is my plan. Because in my opinion, since majority of students are working, so yes, at what time? Right now, because I thought I will keep a space about it, I will ask you people about it. So, yes. So, Saturday evening, for example, if I say we can conduct class at 15:30 onwards. For example. Okay, for example. Only 3 classes there are. Okay. So we will see. Yeah. Okay. Okay. Another course at this time. So we have to then check it. Maybe in the evening, Saturday evening, we can say, for example, but then it will be Ramadan. We cannot do. Actually, it will be falling in Ramadan. You know, these Ramadan will start. Then there will be time of iftar and other things. So we will see. We can adjust it in some way. Okay, don't you worry. We will see. So we can adjust it. We will find a way. Right now, what my plan is, which I actually prepared last night. So then is the merger and acquisition, reconstruction. Around, I have mentioned 3 lectures, but I know it takes minimum 4 lectures. We need to conduct 1 additional class because of detailed practice. Because of detailed practice. Now, so students, let us proceed further. Any question from your side so far? Any question so far, please? Okay, now. Exactly. So you see here for the material. Yes, a good question it is. These study notes, course notes, the content of the syllabus, my notes will be sufficient for you people. And they will be available to volume 1. I have finalized it, only need to be uploaded. They're available with me right now. Okay. So even after the class, or maximum by this evening, they will be available to you on the website. You can download, print that. Okay, volume 1. And there will be 3 volumes. 3 volumes of notes. Second is exam kit. Of course, I'll provide you exam kit as well soft copy. But I suggest to you not to print exam kit or question. Why? The reason is I want my student to practice on the computer or on their laptop, because their exam has to be held in the computer. So they should be practicing questions just like in the exam environment. Right now. So this is what I'll be doing. These notes are more than sufficient. But if you say, no, I want to study some book as well, so that choice is yours. Kaplan or BPP, you can read if you want to study, if you have time. Students, one more thing. Before I start my lecture, please, for AFM especially, students, what is the important? The most important thing is consistency. The most important. Consistency in attending the lecture and consistency in preparation of the lectures at home by you. Prepare. If you are not consistent, you are at risk, I'm telling you. Risk of what? Risk of not attempting your paper. I'm telling you in advance. For example, let me tell you, I am teaching some discounted cash flow technique and you miss that lecture, you don't prepare that, what will happen? Now, discounted cash flow points will be utilized in number of methods. WACC, merger and acquisition, and its impact will go at till that. I am teaching you Modi-Gilani-Miller theory or WACC. Its impact will not stay in the merger and acquisition, investment appraisal only. Its impact will go in the merger and acquisition and reconstruction as well. So if you are missing your lecture, you are not preparing that, its impact is not limited to the area you are studying. Similarly, I am teaching currency future or exchange rate conversion. Its impact will not stay here. It will affect multiple topics in the currency and the interest rate risk management. That's why I'm telling you in advance. You can consider it by first warning about AFM. If you are missing class, and if you are not preparing that lecture after the class very well way, what will happen? You will eventually drop out the paper. I am telling you in advance. So that's why I normally say AFM requires from the student on average 150 to 170 hours self-study. By the way, all professional papers, which are optional paper, they normally require more than 130, 140 hours on average. Exceptional cases may be there. So it dictates that you have now 5 months. So if we see how many hours per month, minimum 30 hours. Minimum 30 hours per month. And per week, how many? 6 hours to 8 hours self-study. Okay, in the first week, yes, 6 hours minimum. What my experience is, if you start doing 6 hours study from the day first per week, it is manageable. Of course, in the final month, you have to do a lot of practice and revision. Weekends, we can utilize more hours over there. So please focus there. And you cannot achieve the desired result when you don't utilize the relevant recipe, relevant methodology, you don't put the required efforts, you cannot achieve. Now, next. The next point is, yes. So these points you should note down. So, student, we are starting. Introduction of subject is almost done. Now, we are starting ARR, payback, discounted payback, and one more thing. I'll be teaching AFM in Excel sheet. And those sheets, I will be sharing with you the link of those sheets. Okay, that I will be sharing with you. And you will, every week at the end of class, you can access that sheet for checking and for the review of that. Okay, so let us start discussion on AFM. Just a minute, please. Let me open the Excel in front of you. We are going to start discussing AFM. Just 1 minute. I'm going to share my AFM class. Yes, folder with you as well. Okay, in few minutes. Yes, here we are. Yes, here we are. So Excel sheet, here it is. And today is 8th Jan, classwork. Yes. So students, the first topic is investment appraisal technique. Investment appraisal technique. Now, my question from you is, why to do investment appraisal? Why to do investment appraisal? Yes, please. Why to do investment appraisal? Yes, please. My question from you.
Evaluate if you want to do the investment.
Yes, that whether the company should make the investment or not. Yes, whether to launch a project or not. But the reason, because a huge amount of money, effort that is involved. That is involved. So investment appraisal techniques, different techniques and methods are there to check the investment. There are, that is accounting rate of return. Students, my screen is visible to you people properly? Excel sheet? Tell me, please.
Yes.
Good. Listen, please, one more thing. During the class, if I am explaining a concept, I am doing a calculation, I try my best to move according to, but thinking that explaining everything in detail, it might be possible. Sometimes I have done a calculation, applied a formula, and you are unable to understand it. I urge you to immediately give me a buzz in the chat box or open your mic and you can tell me that Mr. Hamzah, can you please re-explain it? Can you show me the formula? Don't wait. Because what will happen? I will move on. And if you are unable to understand it, you will be stuck there. And you will not be getting the next concepts. So please. So this is the responsibility I have to give to you people. That you have to take care of your understanding with me. Means if you, for example, if you miss something during the lecture, which you are unable to understand, please ask immediately. Now, don't wait. Okay, accounting rate of return, which is also, the name is ARR, ROS, return on capital employed as well. It is also called. Now, the next point is payback period method. What are the other techniques? They are discounted payback. The second is net present value, internal rate of return, IRR. Then is modified internal rate of return, MIRR. Then is adjusted present value, APV. It is IRR. Yes, one I missed. Which one I missed? Yes, I missed one from here. Let me. Yes, it is duration. Duration. Students, these are non-discounting techniques. These are non-discounting techniques to evaluate investment. And these are discounting techniques now. Discounting techniques and non-discounting techniques. Discounting techniques are those techniques which consider time value of money. Yes, which do not consider now. My question from you is, what is time value of money? Anyone, please. What is meant by time value of money? What do you think? Yes, please. What is time value of money? Okay, good. More answers, please. What is time value of money? Okay, good. You can even open your mic and talk to me. Yes, I'll be happy to hear you.
the opportunity cost of the investment.
That's good. That's good. Right? Students, the time value of money is that the meaning is that today's money has more value. You can note down today's money will have more value than the same amount of money if you receive tomorrow. Today's money have more value than the same amount of money you receive tomorrow. The reason, one reason a student Khatija told inflation. Yes, of course. Due to inflation. Second, a student told me, yes, I think it was a student in the class, Sandeep, yes, that in opportunity for investment, that you can invest that money today and you may double till tomorrow. But tomorrow you will you will receive the same. So the first reason for time value of money is inflation, opportunity for investment, and third is risk. Today you are getting for sure. Tomorrow you will receive not confirmed. To some extent, risk is involved. Now, so discounting techniques. How consider time value of money? By discounting and compounding the amounts. And there is no discounting or compounding of amounts. Now, there is no discounting and compounding of amounts. Now, next point. Let us proceed further. So students, starting with the accounting rate of return. Let me show you the notes. Just 1 second, I'll be opening. AFM Notes Volume 1. Yes, here we are. So, accounting rate of return. Yes, the first topic is here. Okay, right. First payback, okay, accounting rate. ARR, also called ROS, ROI. How it is calculated? Yes, it is a measure of percentage return on investment. Return, percentage return. So let's remember, it is the only technique of appraisal which is profits based. Profits based. All other techniques are cash flow based. It is the profits based. So what we do, we calculate average annual profit divided by average investment. How do we do? Let us learn it by example. For example, a project which has these 5-year profits forecast of the project. In millions, for example. Okay, for example, these are the predicted profits of the project. Initial investment required is that is, for example, 1450 million, and scrap value of the investment will be 130 million. Now, we need to calculate accounting rate of return, ARR. For that purpose, what we need to calculate? We need average annual profit. First of all, we need average annual profit. We need. And how that will be calculated? That will be calculated, yes. That will be calculated by adding all these profits. You see here, sum from here to here divided by 5. Add all profits divided by number of years. Average annual profit, which is forecasted. Yes. So initial investment, make it 24. Yes, 2450. Now, the next is next item we need, that is average investment. That is equal to initial investment plus scrap value divided by 2. Initial investment plus scrap value divided by 2. Here we are. Accounting rate of return. You see, the formula is average annual profit divided by average investment. Average investment, we have calculated the similar way. This divided by this multiplied by 100. You see here. So you see here, average annual profit divided by average investment. So we can, yes. Now, it is in front of you. Students, anything which is not clear, tell me, please. So ARR, accounting rate of return, we have calculated. Is it clear?
Yes.
Is it?
So would you
Any
mind
point?
showing the formula for the calculation of the ARR, please?
This one?
Yeah. So it's the average profit over the average investment.
Yes.
Okay, thank you.
Welcome. I appreciate if you ask in this way. Sometimes I may not be able to ask you, is it clear? I will try to ask you again because there are so many calculations. So wherever you think that you are unable to understand, don't hesitate to ask. Now, it is your right. Now, the next is, so for example, example 2. Okay, profits expected are 3350, 2289, 3530, 2890, and 2260. Sorry, okay, 4 years. So these are the expected profits. Initial investment, that is 9,500. Scrap value. That is 300. You will give me answer. Be quick. Calculate. Give me answer. What you can do? Can you use split screen function like this? How many of you can use split screen function like this? Tell me. How many? Tell me frankly. I will, otherwise I can explain to you. It will help you to, means on one side my lecture is going on, other side you can do calculations. If you are using Windows, not Mac, in the Mac it is very simple. On the bar you go above side and there is option. In the window you just press window button and arrow right or left. Window button on the laptop or computer, on the keyboard, window button, keyboard with the right or left arrow. So in this way, you can note, means in one window, my lecture will be going on. You can adjust the window size as well. On the other hand, you can note down and do the calculation. Give me answer, please. And I don't want calculation on paper and calculator. I want calculation to be done by you in Excel sheet. Yes, please share answers. One answer received. Good. So very easy. Very easy. So first of all, average annual profit. Yes. Average investment. So ARR. This divided by this. 61.5%. Yes. I appreciate. Now, student accounting rate of return has some advantages, some drawbacks. Advantages are that it is easy to calculate as data is readily available, easy to understand. Now, students, the point is how the management makes decision if ARR of project is greater than target ARR, then accept the project. Else reject. Now, what is target ARR? Target ARR, which is decided by the board of directors, management, that we will accept the project with this ARR. Target ARR is the one which is decided by the management. Now, next. Next. So students, what are the drawbacks of ARR? Students, drawback is that, yes, one more advantage. It covers full life of project. Yes, full life of project. Drawbacks. Student, profits are subject to manipulation by management. The first thing, profits are subject to manipulation by management. Second, it is a relative term. It is a relative term which does not tell about the size of project, profit, or return. Now you see here, I will explain it. Relative means in the percentage. Answer is in 70% profit. Yes. Now 70%. Now, for example, 70% profit, the amount is 1,700 million profit. On the other hand, they say another project has 30% profit, but big project, and its profit is 75,000 million, for example. Now, based on percentage, we say, okay, yeah, very lucrative. But what is the size of the project? This percentage is not telling anything. Size of the profit or the project. Okay, percentage is not able to communicate. Now, third point. Yes. Students, the target ARR is set on the base of judgment of management. Target ARR. That how much, for example, they say this project is giving 61% ARR. The target ARR is, board decides, for example, 45%. Okay. The 45% is suitable or not? Who will decide? Judgment of management. And wherever judgment is involved, that there may be a problem as well. Problem may be there. Is that clear, students, so far? Now, payback period method. Next.
Sir,
Yes. Yes, please.
before you proceed, I have one question. How do you interpret the ARR? Like we are saying, it's like 61.5%. What does it mean? ARR of
Yes.
60?
Yes, I agree. It is the return on average investment in the project. Return on annualized return. On average, this project If this is average investment. On this project investment, the project is giving this much annual return. Got it?
Yes.
Good. So payback period method. Payback period method. You know, whenever you make investment in a project, your prime concern is that whether my investment will be recovered. You know, my existing wealth level, minimum will be maintained or it will be drowned. The reason is the wealth relates to shareholders. The wealth relates to the lenders who provide loans for investment. We have to return their money. Now, so students, so payback period method of investment appraisal. What is that? It is the time period in which initial investment of the project will be recovered. It is the time period in which initial investment of the project will be recovered. Yes. Time period in which initial investment of the project will be recovered. Now, let us discuss it. How to calculate payback? Yes. It is cash flows based technique. It is cash flows based technique. Now, so for example, a project has the following cash flows. Cash flows, I'm telling, minus initial investment, 15,500, 2,300, 3,750, 4,590, 5,680. Yes. 2,250. These are the cash flows of the project. Yes, cash flows. Now we need to calculate payback. So cumulative cash flow. Yes. Cumulative means total to date. Total. This plus this. Next. Means this recovered, remaining negative this. This plus this. This recovered, remaining this negative. This recovered. Now, we need 4,860. How many we have in the next year? 5,680. It means 3-year complete plus part of year 4 will be utilized to recover this amount. So 4,860 we need 4,860. How much they have in the next year? 5,680. Into, we have 12 months in a year. 12 months in a year. So it is 3 years and 11 months. 11 months. It is amount to be recovered. So 11 months, not 10 months. Okay? Because we are calculating month. So 3 years and 11 months is the payback period of this project. This project will pay back its initial amount in this much time. I hope it is clear. Next. Students, it is cash flow based. I will come towards it, just a minute. What are the advantages? Okay, before I proceed, let me give you people to do some example. 0, 8, 600 negative 3730 2210 1950 1880. Calculate payback. Be quick, everyone. Be quick. I need answers from everyone. Good. 3 year and 5 months, right? So cumulative cash flows column, this plus this. This plus this. What is happening? This plus this. Yes. Yes. So 3 years and 710 divided by 1880 into 12. Yes, 3 year and 5 months. Good. Now, so advantages of payback. It is cash flows based, more reliable than profits based technique. It reduces risk of investment by focusing the recovery of initial investment amount. What is the drawback? What is the drawback? The drawback is that it does not consider time value of money. It does not consider, yes, no discounting. And the same point you can write in ARR as well. Does not consider time value of money. It encourages short-termism. Short-termism. Yes. Excessive investment in short-term projects. Means payback says that choose that project which has smaller payback. So long-term project, long-term growth is ignored, which is risky for a business. It ignores the cash, the full life of project, and hence cash flows occurring after payback period. I will explain it. Note it down. Now, you see, this is the project A, for example. Project A. Now, project B. Same investment. $1,200, $2,100, $2,800, $2,900, $3,500. Sorry. And $3,800. Now you see here, it's cumulative cash. These are the cash flows, cumulative cash flows equal to this. Yes. Okay, right. So 3-year, and 2,500 needed. 2,900 next into 12. So it is 3-year and 11 months. This project has 3-year and 11 months. Now you see here, as per ARR method of investment appraisal, sorry, as per payback method of investment appraisal, payback, this should be chosen. Smaller payback. But what is happening after payback? Year 5, year 6. Based on payback, we decide on its basis only. It is ignoring what is happening in the upcoming year. It does not consider full life of the project. Now, I hope it is clear. So it is done. So students, is it clear to you people? Tell me. Is it clear?
Yes.
Thank you. Yes, what about others?
Yes.
Yes, clear, sir.
Good. So let us proceed further. Let us proceed further. Next. Students, another question. Before we proceed, another question. A project X. Initial investment is, that is 10,500. Scrap value is 1,500. It's cash flows. Cash flows. Year 1, 2, 3, 4, 5. Okay. They are 2,900, 2,400, 1,900, 3,500, and 5,500 cash flows, right? Now, what you need to calculate, required. First of all, payback period of the project and ARR of the project. You will calculate payback. Then I will be calculating ARR because there is an adjustment in it. Be quick, everyone. Be quick. I'm waiting. All right. So some students have calculated ARR too. Good. So I'll see now. You see here. So cumulative cash flows column. So we need to calculate, first of all, we need to write here a negative this. Yes, 0. Yes. This plus this. Now, so 3 year and 3,300 divided by 3,500. 3,300 divided by 3,500. Yes, into 12. So around, yes, it is around 4 years. Yes, 3 year full and 11.3 months. Now the point is how to calculate ARR. Student, cash flows. For ARR, we need profits. So if we deduct non-cash expense from cash flows, we get profit. Because non-cash in the cash flows, when we calculate cash flows, non-cash expense are not deducted, such as depreciation. So when we calculate profits, non-cash expense has to be deducted. Now, so you see here, profit is equal to, so what is the depreciation here? Non-cash expense. Initial investment minus scrap value. This difference will be depreciated throughout the life of the project. Initial value is this, at the end value is this. So difference is depreciation. This is the depreciation. So what are the total cash flows of project? Some cash inflows. Yes. These are the cash inflows. So total profits, cash flows minus this. Total profits. Now, average annual profit, that will be equal to this divided by number of year 5. 5 years. Average annual profit. Average investment. Equal to initial investment plus scrap value divided by 2. Divided by 2. 6,000. So average annual profit, average investment. So ARR. Average profit divided by average investment. Yes. 24%. Any point which is not clear, do ask.
So can I ask you about the depreciation piece?
About the taxation?
Depreciation.
Sure, please ask.
Why are we calculating the depreciation?
Because we need profits. We have to convert cash flows into profits. These are the cash flows given. In order to calculate ARR, we need profits. So how profit is calculated? Cash flow minus depreciation is non-cash expense. Profit minus depreciation will be the, cash flow minus depreciation will be the profit. So for that purpose, we need depreciation to calculate profit. So first of all, total cash flows we took. Then out of that, we deducted depreciation. And we got profit. Then average annual profit. Is that clear?
Can I see the formula for depreciation?
Depreciation formula is very easy. Initial investment, initial value of investment. We invested this amount. At the end, remaining 1500. So it means difference is depreciation. Okay. Yes. Is it clear now? Anyone, any question, any more question, please? Clear to everyone?
Yes.
Good. Now, so students, we will take a short break of 10 minutes break. It will be. Okay. After 10 minutes break, we'll be back and we will be continuing. Yes. The next is ARR payback done. Discounted payback. Very easy. It will take maximum 5 minutes. Then duration. NPV, IRR, MIRR, very easy. We have time. Half lecture still there. So see you in 10 minutes time. Yes, students. Now, the next point is, that is discounted payback. This payback method has this drawback. It does not consider time value of money. Payback method. So discounted payback then came. It was introduced. So discounted payback method, everything remaining the same. For example, this is the project. I will copy these details from here. Okay, let us pick this from here. So this is the project. Now, so cost of capital or discount rate, that is 10%. We need to calculate discounted payback period of the project. Now, you see here, present value at the rate of 10%. We will calculate present value of cash flows. You see here. What is the formula for present value? Yes, we know that from F2, I think. Present value is equal to future value into 1 plus R raised to power minus N. Now, so we will calculate. You see here, this future value into 1 plus R. This is R. Raised to power minus N. Note it down. Note it down, please, this formula application. Now, so you see here, simply apply this formula. Okay, one thing I have done. Okay, let me write instead of this 10% here. 1 plus 10%. Same? Yes. So present values of all the cash flows have been calculated. You just can see the formula. Now, cumulative cash flows column. Cumulative. Now, this cumulative cash flow column we will make on these present values. This plus yes. So by chance, you see here, let me change this amount, otherwise it is not recoverable. Yes. Now, right. So you see here. So 2982 we need. So 4 year is equal to 2982 divided by 3260 into 12. So 4 years and 11 months. Once again, please check that. If there is any confusion, ask me, any point.
Can I see the formula in the cell for present value?
Present value, sure. Here it is. Oh, sorry. Here is the present value formula. Yes. I have applied the same. Future value into 1 plus R raised to power minus N. N is the number of years. Now, here we are. I hope it is clear. Discounted payback. The next is, but the one problem is still there. What is that? What will happen after payback period? It's still not considered full life of the project. So that problem is still there. So students, that problem is still there. So for that purpose, we need to calculate, just see here, you have 0. For that is the duration is the issue. Duration is the investment appraisal method. What is duration? It is the weighted average time to recover the cash flows of a project. We have not talked about investment. Weighted average time to recover cash flows of a project. Now, just see here. Students, how to calculate duration? Very easy. I will teach you step by step. For example, a project has the following cash flows. Here 0, 1, 2, 3, 4, and 5. Investment is 10,000, 2,400, 3,100, 3,380, 3,475, and 3,700. These are the cash flows of projects. For example, cost of capital is 10%. We need to calculate duration. So what to do? First of all, we will find the return phase. We will be ignoring cash flows. What I will be doing? Simply, I will start taking the positive cash flows of the project. I will ignore investment because it does not talk about investment. It talks about how much time it will take to recover in cash flows, total cash flows, full life. So you see here, year 1, 2, 3, 4, and 5 year. Now, focus everyone. What we will do, present value at the rate of 10%. So the first step is calculate, step 1, I will write. Calculate present value of cash flows. Cash inflows or cash flows from return phase. Return phase means investment we ignored. Step 1. So future value into 1 plus 10% R raised to power minus this. Return phase. Check it, please, formula. Check this formula. So present value of the return phase. Now, so total present value is equal to sum. Here we are. Total present. Step 2. Get total present value of return phase. Now, step 3. Calculate weighted average for each year cash flow. Just see here. This each year, yes. This divided by total present value 954.1 into relevant number of years. How to calculate that weighted average? In exam, you need not to write steps, you just need to do calculations and interpret your calculation. Here we are. So calculate year cash each year present value of cash flow. Yes. You see here. Weighted average. Present value divided by total present value into number of years. Duration. Sum. Three is the answer. This is the duration of the project. Just note it down. If you have any issue in the calculation, ask me. I will explain this answer. Then, if it is clear, write clear in the chat box. Otherwise, ask question, please.
How do we get the duration? Is it given?
This one?
Yes. Okay, thank you.
Welcome. Now, so I will be explaining it. You know, duration is the weighted average time to recover the cash flows of project. Weighted average time, 3. If the value of duration of a project is more than half of life of project, it means majority of cash flows of project are in the later year of the project. Note it down. So basically, duration tells the pattern of cash flows, that how cash flows are occurring. If duration is 3.5, 4, again, it means a huge majority of cash flows will be in the last year. Right, notice 3. It means bigger amount is here. Bigger amount of the cash flows. But if it is 4, it means majority, means great proportion. Only some few cash flows are in the early year. So basically, duration is telling the spread of cash flows over the life of project. When you so payback period was also the same. When we are getting the most amount of the cash flows we want.
At the end of a project.
Yes. So this explanation is clear?
Yes.
Good. Now, if for example, if duration is 2 for this project, for example, how we will interpret it? That majority of the cash flows are earlier year of the project. In the earlier year of the project. Because it is less than the half of the. If duration is 1.1 as compared to 2, it means most earlier years, year 1 or year 2, start, maximum cash flow you will get. In the final years, very small amount of cash flows will be there. Got it? Is it clear to everyone? Tell me, please.
Yes.
Good. Now, good. So, students, duration has a drawback. That duration is difficult to conceptualize or understood by business manager. They are difficult. It is difficult for them to understand this concept, which are non-finance people. Now, so duration is done. Now, I will give you a question. Here, 1, 2, 3, 4. 1200, 5 and 6 and 7. Okay, make it 7200, 8500, 9500, 3,100, 2,200, 1,800, and 1,000. Cost of capital is 15%. Calculate duration. Be quick. Be quick. Calculate duration. Okay, one answer received. More, please. Guests waiting for answers, please. Be quick. Tell me. Students, calculate present value of return phase. Okay, it is already return phase. Total present value. Divide with total present value multiplied by, yes. Okay, let us calculate. Let us present value at the rate of 15%. This into 1.15 raised to power minus this. 1.15, 15% discount rate. So present value. Total present value. Double to 955. Weighted average. This divided by double to 955 multiplied by number of year. Number of year. Here we are. So duration. Sum 2.51. Yeah. 2.51. The people who are getting one, please check their answers where they have done mistake. If there is confusion, ask me, please. Yes. Should we proceed further? Is it clear? Those who are getting answer one, please let me know. Is it clear? Now, student, what is its meaning? How you will elaborate it? The project duration is less than half of project life. That is half of life. So its majority of cash flows are in its earlier years. Now, so duration is done. Duration is done. Now, the next topic is net present value. NPV, net present value. Yes. What is net present value? Yes, NPV, method of investment appraisal. Listen, story. You have to invest in a project. You go, you arrange funds. You borrow money from people. You invest in the project. Now, project has to pay its regular cost of funds, and then eventually it has to pay initial funds borrowed for the project. It has to do that, the project. If after making all the above payments, still amount is remaining, in excess of cost, that is positive NPV of the project. Now, instead of narrating you definition which you have been studying before in F2, I will explain in another way. So NPV is basically how it is calculated. Present value of cash inflows minus initial investment. Present value of net cash inflows. Yes. That we calculate cash inflows minus all the costs. Then we discount them, pay cost of funds. Means first regular cost, then cost of funds through discounting, and then initial investment is paid. That is called, if still amount is remaining, you said now, wow, after payment, everything, we have still amount with us. This is called positive NPV. This is called positive NPV. So that's why we say that if NPV of project is positive, it means it is increase in wealth of business owners. That we borrowed funds, we invested, we paid all costs, we paid initial investment, still amount is with us, additional. Now that amount, who owns that amount? We. Our wealth has increased. Now, if NPV of project is negative, it means decrease in wealth of owners. That's the reason we say accept the project if it is positive. So, accept the project. And here, so in this case, reject the project because, yes. So now, why negative reject? Because after making payment to shareholders, or after making regular cost, initial investment, there is shortage of funds. We have to make up those payments through our own other wealth. So NPV, this project is costly for us. Now, next. The next point is, so NPV, NPV calculation. Okay, we will be talking about it in the next class. It's further complexities. Here they are, NPV adjustments. So NPV introduction. So then this point is clear that why NPV leads or how NPV leads increase in wealth and why it should be positive NPV should be accepted.
Yes.
Good. What about others? Tell me, please. NPV conceptual idea. Now, you know, the students are studying with me, one or two students, triple advanced audit as well. I don't ask this much over there, that is it clear? Is it clear? I don't ask this much. Here I am more concerned because small points make it problem. Internal rate of return, IRR. Internal rate of return, IRR. IRR. So it is again average annual rate of return offered by project. But here we consider cash flows. IRR, average annual return offered by project. That's how much project is giving us, considering time value of money, reinvestment, discounting, compounding factors. How much it is generating? Effective annual return by project, considering time value of money and cash flows. Yes. You see here, for example, project is here. I will take the same example. Okay, let us take this example. This is a project. Here 0. And the investment is, for example, that is 15,000. Cash flows of project. Now IRR. IRR is calculated like this. IRR and simple this formula. Here we are. This is IRR of a project. Internal rate. The project is yielding effectively 36.2% on annual basis. Return. For example, cost of capital, funds cost, that is 20%. So this project is giving how much extra? 16.2%. So that's why it is a wonderful project, that after making payment everything, all the costs, it is still giving us 16.2% extra. If IRR of a project is greater than cost of capital, we say accept the project. And if IRR is less than cost of capital, it means project is return is too low. It is not covering its cost. we say reject the project. IRR is the effective annual return of the project.
Sir, would you mind going on the IRR formula? I just wanted to see if you consider the initial investment. Okay, yeah. Okay, good. Thank you, sir.
Okay, welcome.
So we are allowed to use this formula like is equal to IRR in the computer-based exam.
What I am teaching, the method, the same has to be used exam, because now things have been changed. Okay, we have not to apply that laborious formula which we used to do before. Okay, yes, same way, because examiner is considered is interested in analysis. He said, I don't want you to memorize formulas. Explain me what you are doing. The answer, analysis, evaluation, judgment. This is what examiner wants. Now, next. Let us proceed further. The next point is IRR advantages. It is cash flow based. Yes. Very good. Considers time value of money. Clear cut decision rule. Yes. More than cost of funds, accept. Otherwise reject. Drawback. Yes. One more. Yes. Consider full life of project. Full life of project. Drawback. Now drawbacks are a bit tricky. The first drawback is that is the same. We have it. Yes. It is a relative term and does not consider size of project, same as that of ARR. Answer is in percentage. So big percentage, small amount. It does not indicate what is the amount. It talks about only percentage return. Size is not its topic. That how much return in amount. Second, I'm not going to elaborate again because I elaborated a few minutes, 1 hour ago, I think, this point. And the second point, IRR. Assume that cash flows of projects are the excess cash flows reinvested at IRR at a rate of return equal to IRR, which is not possible always. Yes, sometime it may be possible. I will explain. These are the excess cash flows generated every year. Net cash flows are excess cash flows after payment of everything. IRR says that you can reinvest these cash flows at same rate. This is the return by this project X, for example. They say the excess amount you are earning, you can reinvest somewhere else at the same rate of return. If this project is this much successful, I may not find similar level of profitable project anywhere else. I may not find. So it is not always possible to do that the same. So this is called reinvestment assumption. This is a problem. That you may not be able to reinvest excess amounts at the same level of return rate. Third point. For projects with more than one negative cash flows throughout its life, sometimes more than one IRR are generated, and sometimes or no IRR. It gives error that we cannot calculate IRR. Spreadsheet. Sometimes more, I will explain it. Don't you worry. Now, I will explain. For example, a project is the cash flows, for example. It happens not always, sometimes it happens. These are the cash flows of projects. Initially negative, for example, again negative. Net cash flow negative again. And move 6, once again negative. So more than one is negative cash flow life of project. These cash flows are called non-conventional cash flows. What do we call as well? Another name for these cash flows. The cash flows which are having more than one negative cash flow throughout their life. So if we calculate, sometimes it happens for such cash flows, what happens? More than one IRR. It may give IRR like this, that, for example, 15%, 35%. For example, it may give or it may give error message. You see here, if we calculated IRR, It's a negative error. You cannot calculate. No IRR. For example, so no IRR I have proved. So cost of capital, for example, that is 20%. In this case, now whether the project should be accepted or not, very confusing result. 15% IRR, we should not accept. So 35% we should accept. So hence, the problem is there. So then, is it clear? Multiple IRR or no IRR? Tell me, please. Is it clear to everyone, this point?
Yes.
Good. Students, then came now the last topic for today. Modified internal rate of return. MIRR. It resolved these both issues, reinvestment and this IRR issue. So for example, we take this project, the same. Cost of capital is 10%. And for example, we assume reinvestment rate, that excess cash flows can be reinvested at 8%. For example. Yes, that excessive funds you can invest at 8%, not even 10%. So now you see here, MIRR. How to calculate? Yes. Just see here. Select all. Discount rate first, then reinvestment rate. Just a minute. 6%, yes. You see here. I repeat. Here we said reinvestment rate is an issue. That reinvestment assumption is wrong. It assumes it is reinvested at a higher rate. So any rate you can put here, whatever is available. The formula is here. MIRR. You select all cash flows of the project. Just a minute. Why it is doing a problem? Just a minute, please. Let me try one thing. Yes. Okay, good. Yes. So it is giving 0% accurate answer. MIRR. I change the amount, it is changing the answer. So you see here, for example, so it is actually a negative. So let me reduce it further negative to get a good answer for explanation. Now, so 5%. So you see here, we took cash flows, finance rate, and reinvestment rate. Students, so the both problems, Project with more than -1 cash flows, we have taken the same. Reinvestment assumption as well. So MIRR resolved the both issues. I hope it is clear. So I will give you some question. So for example, cash flows are here. Yes. Cost of capital is 10%. Reinvestment rate, that is 15%. For example, we have available place to reinvest fund at 15%. So calculate MIRR. Be quick. Be quick, please. MIRR, cost of capital, reinvestment rate, 13%. 13%. Students, I am sending you the notes volume 1 here in the chat box as well. And I'll be sharing you this file, which I have prepared for the class. This what I have solved. Okay, now in the chat box. Okay, when your WhatsApp group will be, you can download this file and can save in a folder. So the volume 1 of notes as well, I will be sending you. Just a minute, please. Just a minute, please. It is processing. This video of the lecture will be uploaded to the portal website within next 24 hours. And remember one thing. Don't miss the class. This video will be uploaded for the revision purpose, not the first-hand knowledge. Sitting in the class, attending the class disciplines you. It helps you to stay on the track. But if you fall in the trap, that okay, I'll be watching videos. No, that is a trap, I'm telling you. Okay, you will be detracked. Thank you, students, for joining me. God bless you. Next Sunday, we'll meet, and the next topic will be, we will continue, and please do revise. I'm telling you, it will be risk if you do not revise, because in the next class, I will be discussing NPV adjustments, NOT perpetuity, risk and uncertainty. And most probably, I'm telling you in advance, I will be discussing these as well in the next class. Okay? Now, topic preparation is your challenge at home. Notes I have shared with you, people. Yes. You can see the modified duration I have not discussed. And it will discuss at the end of the course. I know, because it has linking with the bond. Duration, NPV, IR, MIRR. Okay? To the notes. So that's it. Thank you. Take care. Goodbye. Thank you.